The global economic landscape has always been prone to boom-bust cycles, with recessions emerging from time to time, shaping the perception and strategies of investors and governments. A few years ago, the economic narrative was saturated with fears about an impending recession, which generated a widespread sense of uncertainty and caution. However, the current discourse has shifted dramatically to a more optimistic view, with many economists and analysts talking about a soft landing, a scenario where the economy slows down but does not collapse. This optimism is fueled by signs of resilience in various sectors, but it is important to remember that economic forecasts do not always come true as expected. The phrase, "only the paranoid survive," remains relevant in the financial context, especially in times of apparent calm. Paranoia, in this case, refers to constant vigilance and preparation for adverse economic scenarios. While many believe that the danger of a recession has passed, other more cautious observers see signs that a recession may still be on the horizon. This perspective is rooted in U.S. economic history, where a pattern stands out. Recessions often occur after the Federal Reserve, Fed, ends its interest rate hike cycle, rather than during the rate hike. What makes the current situation particularly unique is the unprecedented economic environment that the Fed and the financial world are facing. In recent years, the Fed has injected trillions of dollars into the financial system through stimulus and quantitative easing policies, measures taken to combat crises such as the COVID-19 pandemic. This has created new market dynamics, where the impacts of traditional economic policies may not follow the same historical patterns. For example, inflation has been controlled to some extent, but the interaction between interest rate hikes and the withdrawal of these massive financial stimuli is still unknown. The market is therefore at a crossroads. While the global economy is showing signs of resilience, with growth in key sectors and low unemployment rates, the impacts of the withdrawal of financial stimulus and the increase in borrowing costs could create a domino effect, leading to a deeper than expected slowdown. In this sense, maintaining a paranoid stance, in a good way, could be crucial for those who wish to protect themselves against possible economic shocks. Prudence in times of uncertainty is never a mistake, especially when history shows us that the post-rate hike period can be the most dangerous. Thus, the soft landing scenario may be a temporary mirage, and the true depth of economic changes may not yet have fully unfolded. In times like these, paranoia is not synonymous with fear, but rather with being prepared, adopting a vigilant stance, and seeking protective strategies in an environment that may still hold surprises. It is important to be alert to the signs, even if they seem confusing or contradictory, and to remember that history is often a valuable guide to understanding what may lie ahead. Patrick Bet-David offers an interesting perspective on the current state of large corporations and the impact they have on market performance. While the S&P 500 is near all-time highs, he points out that this growth is largely driven by a small group of tech giants, the so-called Magnificent Seven. Companies like Meta, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla play an outsized role, representing a whopping 28% of the S&P 500 index. This level of concentration of power and influence has never been seen before. The reality, however, is that if we excluded these seven giants, the S&P 500's performance would be quite different. In fact, it would be down, indicating that many smaller companies are not benefiting in the same way. This scenario creates a kind of illusion of prosperity, as the overall market performance appears strong, but much of it is concentrated in a few companies. Patrick Bet also highlights an intriguing contrast between employment figures and the sentiment of corporate leaders. On the one hand, unemployment is at historically low levels, which on the surface would suggest a stable and healthy economy. However, many CEOs of large corporations are worried about the future. According to surveys, 84% of these business leaders expect a recession in the near future. This creates a dissonance between current economic data and future expectations. Large corporations, in particular, are bracing for a possible economic downturn, reinforcing the idea that despite the positive numbers now, there is an underlying concern about the sustainability of this growth. This analysis by Patrick Bet-David reveals the complexity of the current scenario, where the success of a few companies can mask the difficulties faced by many others. Furthermore, the divergence between the optimism of economic indicators and the pessimism of corporate leaders generates uncertainty about what is to come. and this can have major implications for investors and entrepreneurs. The current economic climate in the United States is becoming increasingly challenging for many families due to the significant increase in interest rates, which is directly impacting personal debt. Credit card debt, in particular, has reached a worrying milestone, reaching $1 trillion, the highest amount ever recorded in the history of the country. This exorbitant growth in credit card debt not only reflects the rising cost of living, but is also being fueled by the continued rise in interest rates, which have reached historically high levels. As a result, consumers are facing increasing financial pressure, as high interest rates make it harder to pay off these debts, increasing the burden of monthly payments and making it harder for many families to recover financially. The impact of this situation goes beyond simply increasing financial burdens. The resumption of student loan payments, which were temporarily suspended during the pandemic, will add a new layer of hardship for millions of Americans. An estimated 30 to 40 million people will be affected by the resumption of student loan payments starting in October, which will represent a significant new financial burden for these families. With payments resuming, many of these individuals will have to shell out an average of $300 more per month to meet their student loan financial responsibilities. This scenario creates a real financial storm as credit card and student loan costs rise, household budgets become increasingly tight, forcing many families to make difficult choices about their financial priorities. Not only does this increase emotional and psychological stress, but it can also result in higher levels of default, as some consumers may not be able to keep up with all of their financial obligations. The combination of high interest rates and the return of student debt payments creates an environment where many could see their finances deteriorate further unless there is a change in economic policies or consumers are able to find ways to provide financial relief. Thus, the impact on American families is significant, and concerns about their financial future are becoming increasingly evident. This is a time that requires careful financial planning and, possibly, the adoption of strategies to mitigate the effects of these increasing financial obligations. The housing market is going through an interesting and complex period, especially when it comes to lending and mortgage rates. Although mortgage rates have risen to over 7%, the impact on the market has not been as significant as one might think. One of the main reasons for this is that many people are still holding on to old mortgages that were taken out at a time when rates were significantly lower. These older mortgages, with more favorable terms, are keeping homeowners from having to refinance or buy new homes, which is limiting the current market movement. The rise in interest rates has therefore caused the number of refinancings to fall dramatically, in addition to discouraging the purchase of new homes. Most buyers are waiting for a more favorable economic environment before making any decisions. However, this situation, although temporary, may be indicative of a more significant change on the horizon. Patrick Bet-David points out that the market behavior suggests that a recession may be on the way, since there is a historical connection between the end of interest rate hikes by the Federal Reserve, Fed, and the occurrence of a recession. Typically, there is a considerable lag time between the end of the Fed's rate hike cycle and the onset of a recession, with the historical average being about 11 months. This means that even if the Fed stops raising rates now, the real impact on the economy could be felt most acutely almost a year later. This lag in the economic impact has led to debate about when exactly a recession might occur, with some forecasts suggesting that it could coincide with the upcoming U.S. presidential election. Thus, the real estate market remains relatively stable, but warning signs of a possible economic decline are beginning to emerge. The dynamic between the slow reaction of the real estate market to high interest rates and the expectation of an imminent recession leaves the economic environment full of uncertainty. The current moment is marked by a cautious wait, both on the part of consumers and investors, who closely monitor the Fed's decisions and economic indicators to understand when and how the market will be truly affected.